You know that feeling, right? When you're just trying to get started with investing.
Oh yeah, information overload.
Totally. It hits you from like all sides. One person's telling you buy the dip, another's all about dollar cost averaging.
Mm-hmm. Then index funds, maybe some crypto, day trading.
Exactly. And they're all talking at once. It's honestly enough to make you just freeze up.
It really is. You want to be smart, but yeah, the noise can be paralyzing.
And it feels like you miss something, maybe something simpler.
Well, it's interesting you say that
Oh.
because often what's lost in all that activity, is a more basic long-term view.
Which is why this thing Warren Buffett said way back 1985, I think. It really stuck with me.
What was that?
He just said, very simply, the stock market is designed to transfer money from the active to the patient.
Ah, yes. That one sentence, it really flips the whole script, doesn't it, on how so many people think about the market.
It does. It suggests all that frantic buying and selling. Maybe it's working against you.
Could be. In the long run, absolutely. Patience pays.
Right. But okay, here's the thing. When you first hear that patient, it sounds great. But what does that actually mean? Like, practically.
That's the million-dollar question, is
Yes.
how patient? Patient with what?
How long are we talking? What kind of patience are we applying here?
Exactly.
Yeah.
Because it's not just, sitting on your hands indefinitely with just anything. There has to be a method behind it.
Okay. And that's where this idea comes in. This maybe forgotten rule, you could call it, a 10-10-10 approach.
The 10-10-10 framework. Okay. Let's break that down. What are the core ideas?
Well, it boils down to 3 key questions you ask yourself. First,
Mm-hmm.
do you genuinely believe the company you're thinking about investing in will, still be around and doing well 10 years from now?
Okay, 10 years. That's a solid time frame.
Mhm.
What's the second 10?
Second, are you comfortable actually holding that investment for at least 10 years, even with all the, ups and downs that are bound to happen?
Right, so commitment to the holding period. And the third.
And the third 10 is about selling. Would you only think about selling if the fundamental health of the business itself has gotten worse for 10 quarters in a row?
10 consecutive quarters. So that's, 2.5 years of steady decline in the business, not just the stock price.
Exactly. 2.5 years of the actual business deteriorating.
Wow. Okay, what's really striking about that, the 10-10-10, is how much it clashes with, well, pretty much everything we see today.
Right.
You've got apps that make trading feel like a game,
Hmm.
the 24/7 news cycle jumping on every tiny market wiggle.
Oh, totally. It feels like this constant pressure to be doing something, always reacting.
Yeah, exactly. So this 10-year thinking, it feels almost radical.
It really does. It's the
Awesome.
complete opposite of the instant gratification thing we're so used to. So yeah, no wonder this kind of long view approach might get, well, forgotten.
Absolutely. And you have to think, the way a lot of the financial industry is set up, activity is often encouraged, right?
Makes sense. More trading, more commissions, more clicks.
Precisely.
Yeah.
A philosophy based on just holding tight and doing very little.
Mm-hmm.
It doesn't really fit that model as well.
It really makes you wonder, though, if focusing long term on the actual strength of the business is so important, what happens if you actually try to stick to this 10-10-10 rule today?
That's the really interesting question, isn't it? It challenges so many of those knee-jerk reactions that trip investors up.
Yeah.
It forces you to go deeper, to really think about the lasting potential of the companies you're backing, not just the ticker symbol flashing on the screen.
And that idea of waiting for 10 quarters of bad news about the business, I mean, that's a serious commitment
It is.
to looking past all the short-term market drama and focusing on, well, the fundamentals, things like their actual sales, profits, debt levels, the real engine of the business.
It shows you've actually done your homework,
Yeah.
that you understand the business and its industry, and it means you're willing to ride out bumps, even big ones, as long as your core reasons for investing are still valid.
Okay, so let's imagine this scenario. Someone actually applies this rule. They make an initial investment, maybe add a bit more later. What could they realistically expect?
Well, let's think about it.
Yeah.
Someone sticking firmly to this kind of long-term fundamentals first strategy, even through some rough patches,
Yeah.
they might actually end up doing pretty well,
Mm.
even if not every single stock pick was, a home run.
Right, because it's not just about hitting it big on one stock. It's more about the discipline of holding good companies through the cycles.
Exactly. Think about a really turbulent time like the start of the COVID pandemic crash back in early 2020.
Yeah, that was rough.
Someone committed to that 10-year view.
Hmm.
They'd probably be much less likely to hit the panic button and sell everything when the market dropped, what, 30–35%?
Oh, absolutely critical. Because selling right then, locking in those huge losses, that's where so many people get hurt.
It's a classic mistake. But actually, for the 10-10-10 investor, those downturns could look different. Well, if your research holds up, if you still believe in the long-term story of those companies, a big market dip is actually a chance to buy more shares of those great companies, but cheaper.
Ah, so you lower your average cost per share.
Exactly. Which sets you up for potentially better returns when things eventually
Yeah.
recover, right?
Right.
Makes sense.
Plus, by sticking to the plan, not constantly trading in and out, you really let compounding do its thing. And you avoid getting nibbled to death by trading fees and taxes from selling all the time.
So it's kind of twofold. You dodge the big mistakes, like panic selling, but you also just let the good businesses grow, uninterrupted.
That's a really crucial part. If you focus on companies with solid fundamentals, strong competitive advantages, loyal customers, good management, they're just much more likely to handle tough times and come out stronger.
It sounds like taking this 10-year view also gives you a pretty big psychological edge as an investor.
It really does. When you anchor yourself to that long horizon, you naturally get less bothered by the day-to-day noise and the market's mood swings. Yeah, I can see that. Less stress trying to guess the market's next move.
Definitely less stress. You're not trying to time things perfectly or react to every single headline. It prevents a lot of emotional decision-making.
So instead of seeing a market dive as a total disaster, your mindset shifts. It becomes maybe an opportunity to buy quality on sale.
That's a huge shift in perspective.
Yeah.
Really powerful one. But, we should be clear. This approach isn't easy. It demands certain things for you.
Okay, right. So it's not just set it and forget it entirely. What does it require?
Well, first off, it demands real, genuine conviction in the businesses you choose. You have to truly believe they'll be thriving in a decade.
Not just hope so.
Exactly. Because if that conviction is shaky, the first sign of trouble or the first time the stock lags the market for a while, you'll be tempted to bail.
And that conviction, it doesn't come from nowhere, does it? It comes from, well, doing the homework.
Precisely. Which leads to the second point.
Ugh.
It takes real patience. And patience is hard, especially now when everything feels instant. There will be times, maybe even long stretches, where your investments just don't seem to be doing much. Holding steady through that takes discipline.
It's definitely not exciting, is it? Compared to the thrill of active trading.
Not at all. And honestly, that's probably another reason this 10-10-10 idea isn't plastered everywhere. Patience and minimal activity. It just doesn't generate the same buzz or fees.
It also kind of goes against our human nature, doesn't it? We want immediate feedback. We want action. We react emotionally.
That's absolutely right. So it requires a certain emotional toughness, sticking to your plan, even when your gut or the headlines are screaming at you to do something different.
And fundamentally underpinning all of this is the need to actually understand the businesses. You can't just pick a ticker symbol you heard about.
No, definitely not. You need to grasp what the company does, how it makes money, what makes it special, its competition, its long-term outlook, the whole picture.
Thinking like you actually own a piece of the business, not just trading a stock.
That's the mindset shift. You're a part owner, not just a trader.
It's really fascinating, though, to think that just by committing to that long view, focusing on the business strength, you could potentially get great returns without all the constant stress and activity. Maybe even because you avoid all that activity.
That's the quiet power of it, isn't it? Aligning your strategy with how great businesses actually create value over time and letting compounding work its magic for you.
So, bringing it back to that Buffett quote, the stock market is designed to transfer money from the active to the patient. This 10-10-10 rule really sounds like a concrete way to be that patient investor he was talking about.
Precisely. It gives you a practical framework, a way to resist the urge to constantly fiddle and react, and instead just focus on the long-term quality of what you own.
So for everyone listening, maybe the big question isn't what stock should I buy tomorrow, but something more like, which companies are you genuinely confident will not just exist, but actually be thriving 10 years from now?
That's a really powerful question to sit with. If you can answer that honestly, really think it through, that could lead you straight to your own version of this forgotten rule and potentially, to much better long-term results.
It really just hammers home that old saying, doesn't it? Time in the market, especially focused on great businesses, beats trying to time the market. Every time.